Good Tuesday morning. Welcome back to Opening Bid. I should say welcome back because I was just here yesterday. I am Yahoo Finance Executive Editor Brian Sozzi. There is so much going on in markets today. I don't even know where to begin for you, but begin I must. So here's what's on my mind right now. Big bank execs send a message to Team Trump with the Trump administration launching a new campaign against Fed Chair Jerome Powell. Big bank execs are speaking out immediately. JP Morgan CEO Jamie Dimon said on a reporter call I was on this morning that he believes in Fed independence and any challenge to it would be bad for the U.S. economy. The vibes were similar on a call with BNY CEO Robin Vince. Vince saying this, quote, if you look at the things that underpin the U.S. bond market, that independence is one of those things. And so shaking the foundation of it doesn't seem to be, to us, accomplishing the administration's primary objective. And the Jerome Powell fanboys and fangirls are out in force today. With Jerome Powell under siege from the Trump administration, his meme stock supporters have taken to social media to support who they refer to as Daddy Powell. Can you blame them for wrapping their arms around Big Daddy Powell? Sure, while Powell and his Fed have made a few key mistakes along the way, the market under his watch has done quite well. Consider this. Powell was sworn in as chair of the Federal Reserve on February 5th, 2018. The S&P 500 closed that day at about 2650. The S&P 500 has just crossed the 7,000 mark. And the pursuit of new investing ideas is still underway on Wall Street. We may be 13 days into the new year, but the street remains out in force recommending fresh ideas. This morning, Bernstein pitched blockchain play Figure as its top idea for this year. B of A is out saying there's a, quote, bullish setup on Apple into earnings. So where else should you be looking? More on that in just a moment with my man, Tom Sosnoff. Always looking forward to talking to Tom. On the Opening Bid Roundtable, we got Tom Sosnoff, Lost Dog founder and CEO, alongside Yahoo Finance senior reporters Brooke DePalma and Inez Ferre. Good morning to you all. Tom, always nice to see you. Take us through some of your early thoughts on big bank earnings. The market doesn't, I think they're still trying to figure out, do they put more stock in what the banks are putting up in terms of earnings, or do they worry about Fed independence?
Well, the earnings are the Fed independent. They're definitely worried about Fed independence, but I don't think that that's going to impact, the earnings calls. I think the one thing you have to recognize with the bank stock earnings coming up is that volatility is really low right now. Like the expected move in JP Morgan's is only about 10 and a half bucks. So and we're talking about $300 and something stocks. So about a 3% move. It's not that big and there's not that much juice in there. So I would say that the earnings are going to be a little bit, they're going to be tempered. They're going to be a little bit muted.
Tom, you're an intense trader. I'll even say you're a hardcore trader. You've been doing this for a long time. When your trading week starts with something like a challenge to the Fed independence, how do you factor that into the stocks you trade and the stocks you might trade?
Well, lucky thing for me, I am an efficient market theorist and not a fundamental or technical trader. So I take, anything. I mean, Trump he's a shock jock president, and he likes to say things that are a little bit beyond ridiculous because it draws all this attention, and I think he gets off on that. But the reality is, I don't think there's a single person in his administration or anywhere that's going to support, anything that compromises Fed independence.
Has the market essentially, Tom, said this doesn't, while important, doesn't matter? Stocks came out of the gate yesterday, down, reversed to the upside. Today, they're not doing much. We're starting to cross some large round numbers. I mean, there's other things, I guess, out there to focus on. Well,
of course. And the market's at all-time highs, so you can't look at the market and go, wow, it's really nervous. I mean, volatility is at a multi-year low, and which means fear is super low, and markets at all-time highs. I think the one takeaway you can have from all this Fed talk is that the bond market is the one marketplace that hasn't budged. It hasn't even moved like 2 ticks in 2 months. It's been trading, the long bond's been trading 115 and a half. That's and the notes haven't moved. They're still in that 112 handle, and nothing has changed in the 10-year notes and the 20, 30-year bonds. So I think that if you're looking for something that seems, a little off and cheap, I think that's the only market that's been impacted by all this, ridiculous chatter about the Fed.
And as I know you're still tracking all things commodities.
Oh, yeah, I'm tracking all things commodities. Yeah, I mean, that's a little different world right now. Some of the commodities, like the softs, are in the toilet, and the metals are, in the stratosphere. They've been hyperbolic. And so I think every trader in the world is short silver right here. So throw my name on the list.
And Inez Ferre, let's get you in here because I know you're tracking a lot of these moves here in this market. Yesterday, seeing a lot of bullish moves. Inez, what are you seeing today?
Yeah, look, as Tom was mentioning, every trader's short silver, but take a look at what Citi called out. Citi is saying now that gold is going to go to 5,000 in the next 3 months, and that silver is going to go to 100 in the next 3 months. We have seen a major move in both of these metals. We've seen a move in metals in general, sort of a parabolic move. So this question, obviously, of Fed independence also having an impact in the metals market.
Brooke, new day, new things to watch. What's on your radar?
Well, certainly what I'm watching is Delta earnings. I think that's a sort of barometer here about the insight into what the consumer is looking at right now. Within the second half of the year, Delta continued to see this K-shaped economy. That premium revenue was higher than their main cabin, sort of a reversal of what they had seen earlier this year. But the fact that premium revenue for the company was up by about 9% yet again, that goes to show people are still flying first class. They like Delta One and they're really leaning into it, willing to splurge. And that just really shows that the K-shaped economy persisted into the back half of the year with a spike in that premium revenue. The high-income consumer continues to spend. The low-income consumer continues to be under pressure. Of course, Delta is sort of a bellwether for the airline sector and sort of an insight into how the more premium airliners may perform.
Brooke, Delta is just the best darn airline. I mean, the app works. You get on the plane generally on time. And I don't know about you, Brooke. I've never stayed on Delta One. I can't reach. I mean, that's a little bit of reach for me.
Brian, I'll admit, I only flew first class one time in my life. It was an accident that happened. But I will say that it just goes to show that people think that it's worth the value. Also, then you take into consideration maybe reward points going in that, premium credit cards, things like that, that people are willing to take on maybe an annual fee. They're willing to pay more just to get that sort of experiential economy that we saw a few years ago really tick off.
Good to see us staying humble there, Brooke. Tom, back to you. You know, I mentioned at the top of the show that the meme stock community they're out in force, really supporting Jerome Powell. Are you surprised by that?
I'm not. It's kind of like the whole underdog mentality, and I love it. And just think about how many times in history you can go back for a long time and see how many Fed governors or Fed chairmen, receive support from the meme stock community or the trader community. It's not a lot. So this is a really rare thing, and I think it's kind of cool to see because he would be the least likely hero, for a bunch of young traders. So I kind of think it's cool. I like it.
But he's put a lot of money in their pockets. I mean, rates have been. I mean, look, I'm not saying he has gotten everything right, but by and large, like I mentioned at the top, I mean, the market's been up and to the right since he has taken over as chair.
No question about it. I mean, there's not a person under 35 that has even experienced a downtick in 15 years. So, or maybe even longer, 16 or 17 years. When you start to think about it, the answer is, yeah. I mean, there's no reason not to love the guy. If you just entered the market 15 years ago and you're, less under 40, you're damn straight. He's been daddy. That exactly.
Big Daddy Powell. I mean, Tom, look, nothing goes up in a straight line. I think it was Claudia Sam, who we had earlier on one of the shows this morning, saying that there could be a chaotic transition from Fed chair to Fed chair when Powell eventually rolls off I believe in May. I mean, is now the time to start preparing for more volatility in the markets, or do you wait for like the final day before Powell is ushered out?
Well, I think it may be the time to start. This is kind of a buy the rumor, sell the news type thing. And I think that it's an interesting spot to start getting long some bonds because I think you could see a flight to quality if you see a pump up in volatility. But I do think that the next Fed chair, if it's somebody that is deemed to not be very independent, it's somebody that's, in Trump's pocket, that will not be a good sign for the equity markets at all. People will not like that.
And as I'm really interested to see what trial balloon now the Trump administration tosses out. You've had two of the biggest bank executives come out here this morning and say, we want Fed independence. It's important to bond markets. It's important to bringing down costs in this country. And sure, the bond markets have barely moved in response to this, but still, when these execs send a message like this, I think it should be taken very serious, Inez.
And you'll
Yeah.
likely see more executives sending this type of message, sort of coalescing around Jerome Powell. And not only that, but you are also seeing executives talking about these moves from Trump to sort of make everything affordable again. I mean, you had JP Morgan's CFO, Jeremy Barnum, that was talking about the credit card rate caps, saying that this would be very negative, quite negative, very, very negative, even though he couldn't quantify sort of the impact. You also saw ExxonMobil's Darren Woods talking about Venezuela being uninvestable. So not only are you seeing executives talking around this issue of Fed independence and the need for Fed independence, but also slightly pushing back a bit against some of these moves that Trump is wanting to make, that he wants the industry to make, companies to make, in order to make prices more affordable again.
Brooke, I was going through that Delta report, and for me, it ticked every box of something that I want to see from a company that is priced damn near up for perfection this earnings season. Revenue strong, outlook solid, managing costs, calling out a big business with American Express, double-digit revenue growth. Zoom out for us, Brooke. I mean, what is the read in your view on the consumer after a report like this?
Well, I think it's worth noting that after this report, the stock is falling, and that might be because of the impact that the government shutdown had on Delta. But I think overall, what this report and what we expect to hear from further airlines is that even though, and even JP Morgan saying this in their earnings call this morning as well, is that even though consumer sentiment is near record lows, even though it continues to hover around that, consumers are then turning to their wallets and they continue to be able to spend. We saw in credit card data, and we're clearly seeing it, especially within that Delta premium revenue. And it just goes to show that if consumers feel like it's worth it, then they're willing to make the splurge. And that's not just what we heard from Delta and JP Morgan this morning, but also there's multiple different retail conferences going on right now. And I was at one of them, the big show, the National Retail Federation's big show here in New York City on Sunday afternoon. And what many experts told me there was that if value is there, even if it is come, albeit at a higher price point, consumers are willing to make that splurge. And also self-gifting is something that consumers have really been leaning into, especially with those October, November earlier holiday sales that we saw as well. And so it's really this idea that discount or not, if consumers they have the means and they really want it, they're going to take that plunge.
Tom, I caught a video of you recently. I love the headline. I love when you do your videos. 11 boring ideas. But you started this video off by saying that the end of the bull market might be in sight. I mean, take us through that thinking and hit me with one boring idea before we go.
Well, I mean, I'm a contrarian, right? So I have to stand, I've been a contrarian for 4 going on 5 decades. So I can't flip the cards over now. So at all-time highs, I really have no other choice other than to say, that we have to be, shouldn't say we have to be, is that I think it's not that I think we're rolling over and crashing or anything like that, but I just think the pot odds favor the downside of the market. I think there's a lot of stocks that are very fully priced, and I know there's not a lot of other things to invest in and things like that, but I will just say that I think stocks are fully priced, and I think if you do get any kind of momentum to the downside, like we saw last April, and I expect to see something like that maybe, in March or April or May this year, I think you're going to get a little, I don't think we're crashing, I think you're going to get a little nasty sell-off, maybe 10, 15%.
Would NVIDIA quantify as a boring idea? And I'm going to ask, I asked that, Tom.
NVIDIA would be a very boring idea.
Right, because we all know the story. We know that they're leaning AI. I mean, that is a fair, would that stock withstand some of the volatility you just talked about?
I mean, I love what NVIDIA is doing because having their AI platforms and the technology that they've built is like having a genius best friend that's always available to you, and you can just, pick their brain with 165 IQ anytime you want. It's the coolest stuff ever. But that doesn't mean that the stock is not totally fully priced. And so I just, I look at NVIDIA and I'm thinking to myself, how much more upside in here and what kind of downside is there if this thing rolls over? So it's not a function of, NVIDIA itself. It's just a function of price.
You think NVIDIA still has the largest market cap end of the year?
You know what? I said Google. I don't know why. I was just trying to be different. I think it could be Google, but I don't know. I don't think it's going to be NVIDIA.
Tom, you're the man. Big thank you to my opening bid roundtable. Always great to see you all. I appreciate it. All right, from the Trump administration's war on the Fed to AI possibly taking your job, there's a lot coming at the U.S. economy 13 days into the new year. Visa's longtime chief economist Wayne Best weighs in on all this next. If you're an economist, your year has started off with a bang. The independence of the Federal Reserve is under siege from the Trump administration. With that, inflation expectations could well head north. At the same time, President Trump wants a one-year 10% cap on credit card interest rates. The move can meaningfully ignite consumer spending if passed. And not to be forgotten, the December jobs report generally sucked. The headline number, 50,000, was below consensus in prior months, so a sizable downward revision. So lots in play on the direction of the economy out of the gate in 2026. Wayne Best is Visa's longtime chief economist. Wayne, always nice to get some time with you. I want to start actually with the CPI results here this morning. I'm coming in fairly benign. When does that trickle down into the prices that consumers see at stores?
Well, I think you see that the prices of consumers, the output from a CPI report like that, we're starting to see the tariffs become much less of an issue. I'm not saying it's zero, but it's certainly have come down as both businesses and consumers have found a way to shop differently. The consumers are sorting by price and finding a different priced item. And I think that type of technology that we have available to us now is really quite unique. On the business side, they've also figured out, a classic example in Canada, the dutiable rate is around 35%, but what's actually collected is only 3%. And you don't hear about that often. But the reason is that businesses said, well, I don't belong to the USMCA, the exporters, and maybe I should sign up because before it was a zero tariff rate. And so they've changed and shifted their patterns, their business models, and are now down to 3% in Canada as an effective rate overall. So again, businesses and consumers find a way, and I think we're going to continue to see that. Remember, the CPI is a fixed basket of goods. Mm-hmm. It doesn't mean what you actually buy. It's the price of things overall. And again, in this day and age, with tariffs in place, I think you're seeing the consumer actually do that shift to cheaper types of goods.
Wayne, is the affordability crisis, could we declare that over after a report like this, or is it still TBD?
I think it's a little TBD in terms of the overall impact to the consumer itself. They're still certainly struggling, especially low and middle income households, on the things that they actually buy. But one piece of good news, of course, is what's happening with oil prices. Everybody buys gas, and as oil goes down, gasoline prices goes down, that starts to free up discretionary spending that we see overall.
What is your outlook for GDP in the first half?
For the United States, we have a pretty robust forecast of 3.4% for the year, definitely front-loaded. The tax cuts, especially the elimination in some states of the SALT cuts, state and local taxes, are going to result in quite a bit of additional dollars, refunds, if you will, for consumers itself. If I look at the overall global economy, though, 2.7% growth overall, the headline numbers are actually quite positive when you start looking at things like steady global growth, moderate inflation, and even resilient consumer spending. But beneath the surface, the global economy is really undergoing a massive transformation. Generative AI is accelerating digitalization. Demographic shifts, which you and I have talked about extensively, are reshaping labor markets. And new trade patterns are starting to emerge as businesses adapt really to a more fragmented world. And part of our global outlook identified 5 key themes that we can go into that really define what that outlook will look like, at least on a global basis.
I've been trying to think, Wayne, with the massive investments like you just mentioned in AI, data centers in this country, companies are clearly still investing a lot in their business, even outside of AI. Why isn't the U.S. economy growing quicker than 2.7%?
Well, 2.7 is the global outlook for real GDP. For the United States, our new estimate is 3.4%. So that's substantial growth for the year overall. And again, a lot of that front loaded because of the taxes, but also a massive amount of business investment. We see that in the United States. That's happening globally also. And you're almost getting to a point, well, certainly consumption is the key driver of the economy. In terms of where the growth is coming from, business investment, as businesses continue to try to stay ahead of the curve for using an AI and AI tools.
Will this be a jobless recovery?
It's going to be a slow level recovery, but this is really the demographic shifts that we've been talking about. Once again, I got 11,400 people that are turning 65 every single day between now and the end of this decade. That's a lot of people. Not all of them retire at 65, but many of them do. Immigration is down to, I think last year, the final figures aren't in yet, but maybe 300,000 people came into the country. And we're not having kids. So we talked about this before. So between those three things, 50,000 print is probably going to be expected. I mean, our break even is around 40 to 50,000 now. Anything above 50,000 will cause the unemployment rate to fall further. So we're going to see, we have to really reset what we're thinking about with regards to jobs, because for the last 4 decades, 150, 200, 250,000 jobs was the norm every month. Well, for the foreseeable future, it's going to be 30, 40, 50,000 on average. It's going to be a much slower pace. And of course, we'll see some periods of time when the number's actually negative.
Wayne, I don't want to get down too much into the rabbit hole of this Fed independence thing, but for the lay person out there, help us understand if Fed independence is challenged, and it is being challenged, what is the economic knock-on effect if this continues? And where does that appear?
Well, I think you could start seeing it in the longer end of the market, of course, which the Fed doesn't control. And there could be some uncertainty factors about there that would cause long-term interest rates to potentially rise. It also creates a lot of uncertainty overseas. If the Fed isn't independent versus the way they've been up to this point, that's going to create some challenges for long-term investors into the United States and whether or not they want to invest. And that will obviously have some trade flow issues associated with it. So I think the economic factors will very much be based on what we're seeing in the long end of the markets. I don't expect it to, in fact, impact, lower interest rates in general are positive for a consumer, but the businesses are looking at, borrowing money for 5 to 10 years, and they're going to be impacted with higher rates.
Wayne, always so great to see you. Thanks for always making time for me and us here at Yahoo Finance. We'll talk to you soon.
Thanks a lot, Brian.
All right, before I go, a little financial fun fact for you, or should I say a not so fun fact. It has come time for me to trade in my car. So I was looking around at what's possible this past weekend. The prices for new cars caused me to fall off my seat. I get all these cars are basically rolling computers on 4 wheels and do all sorts of cool things like cool your ass with the touch of a button and help order a $7 latte at Starbucks. But wow, our price is high. And this experience fits nicely with some new data out of the folks over at Kelley Blue Book this week. Car shoppers paid a record average of $50,326 for new cars in December. BMW was the most expensive with an average sticker price north of $72,000. Love the BMW comps, the competition I should say, but that is high. Maybe it's time for me to just take the bus to work. Julian Hyman is back shortly on Market Catalyst.